Hi, mortgage-mike.ca here with you again today. I'm going to speak about variable and fixed rate mortgages today. Seems to be always a question for consumers when they want to renew their mortgage or get a new mortgage, is which is the best way to go? Well, the best way to go is what makes you the most comfortable. I can explain to you the differences here. But you have to be comfortable with your ability to make the payments. And a fixed rate mortgage, you know exactly how much your payments are going to be, whether it be a 1 year fixed, a 3 year, or a 5 year. The difference is the term of the mortgage. That's the length that you have the rate fixed for. So in the case of 1 year, it's 1 year, 3 year, it's 3 year, and 5 year, it's a 5 year. Now the difference between a 1, 3, and a 5 year mortgage is the interest rate goes up as the term increases. So right now you can get a 1 year mortgage for around 2.74%. 3 year mortgage would be around 3.74 roughly, depending on the lender. And a 5 year mortgage is about 4.34, again depending on the lender. There are some fluctuations there, depending on which lender you go to and which different terms and conditions you're after. But basically, the longer the term, the higher the interest rate. And if you wanted to go out to a 7 year mortgage, you'd be looking at around 5.3, and 10 year mortgage, you'd be about 5.5. Again, there's some variations from lender to lender. Now that's what happens with a fixed rate mortgage. You're locked in at that interest rate for that term or that number of years. So if you're a first-time buyer, or you're very conservative as far as your mortgage goes, probably the fixed rate is the rate to go, because you'll know exactly what your payments are for the term of your mortgage. No ifs, ands, or buts. What you see is what you get. On the other hand, if you go with the variable rate, currently a variable rate is set by the bank's prime rate, which is right at this point in time 2.25%. And you may get plus or minus some basis points, but we'll say it's 2.25 for this video's sake. Now, right now, the market we're in with the economy the way it is, the Bank of Canada has stated that there's going to be no change in the Bank of Canada's rate until around June 2010. And if they don't make a change in their rate, the bank's prime rate, which is based on the Bank of Canada rate, is not going to change either. So basically what you can do is get 2.25%. And if that lasts until June, you probably have about 8 months worth of payments at 2.25%. Let's say it goes up in June 2010, then you may have to pay 2.35 or 2.45 or 2.30. We won't know until the Bank of Canada sets the rate what the rate will be at that time. If you have a variable rate mortgage, you need to be prepared for the increase in the interest rate whenever it happens. So if it does go up to whatever it goes up to in June 2010, you'll have an increased payment to pay because the interest rate is higher. So you have to be fairly secure, have good jobs, and know that you have the ability to pay an increased rate when it comes down the pipe at whatever time. And as a general rule, the rates go up a lot faster than they come down. So you have to be wary of what exactly is going on and what the criteria is that the Bank of Canada is using for increasing the rates. So you have to be careful. Now, most of these variable rates have the ability to lock in. So if things start to go too crazy too fast, you can always lock in the rate and be insulated from any further increases. Now let's say it does go up a little bit and you can afford the payments. Let's say it goes up a lot and you can afford the payments. And then the rate comes down in 2011. You still could be a lot further ahead of the game, because instead of paying 4.34, you're probably still going to be in the 2, 2.5, maybe in the worst case scenario 2.75%, which is still a lot lower than 4.75%. So over the long run, you're probably going to be ahead of the game by having a variable interest rate. And you're probably going to save off thousands of dollars in your mortgage payments, and you'll be able to pay your mortgage off much quicker if you go variable. But again, you have to be very secure in your job and not be worried about the ups and downs in the marketplace as far as interest rates go. So, if you're conservative and you want to know exactly what your payments are, you got to go fixed rate. But if you're a little adventurous, you have a lot of equity in your house, and you like a little bit of a roller coaster ride as far as your monthly payments go, well, go variable. And if you have any other questions in regards to mortgages, I'd be more than happy to help you. You can reach me by phone at 416-576-9566, or you can always go to my website, www.mortgage-mike.ca, and leave me an email, or you can download a lot of free information from the website. There is lots and lots of free information on the website. And failing which, give me a call anytime. I'd be happy to help you. Thanks for watching the video today, and I hope to see you again soon.